Okay, well, Mark Matthews is now joining us. He's with Bank Julius Baer and Company. Mark, good to have you with us here as always. Thanks very much. You know, this move in the wicks on Friday and oil jumping and gold prices jumping, all are basically kind of risk-off signals. The Nasdaq was down just a little over 1%. What's your best sense of things from here? Are equity markets taking a bit of a dive here or unlikely?
Unlikely. I don't think that the reason for the risk-off sentiment is because of the stronger September payrolls number that came out the week before last, or the stronger CPI that came out last week. I think it is because of Israel. And when one speaks about these things, one sounds very callous when you know relating them to markets. But if I could just say that if we look back at the terrorist attacks in Bombay, November 2008, over the next 12 months, the Nifty was up 80%. Over the next 5 years, it was up 150%. Over the next 10 years, it was up 350%. So I think the reason the market's gone down is this concern about what's going to happen now. These terrible terrorist attacks have taken place and Israel is on the verge of responding. But history shows us that these geopolitical events do not tend to be disruptive for the market.
All right, Mark, hi, good morning. We don't even want to go there, right? What happened in India with respect to the crisis? Of course, post-crisis, always the returns have been disproportionately higher. And it's in hindsight, it has always been the best thing to buy into these dips. But what do you do now, considering that the market has moved on? I mean, there is a lot of buying that we've seen in markets like India. Do you think that is something that can continue? And for the rest of the calendar year, what would your approach be for India?
I think it's going up. I think that generally markets around the world will go up. And we all know that the benchmark is the S&P 500 index. And we all know that ultimately what moves share prices is the earnings of the companies that those share prices represent. The third quarter earnings kicked off last week. So far, only 32 of the 500 S&P constituents have reported. But what those 32 companies have done is beat consensus estimates by 10%. And 85% of the 32 beat the consensus estimates. And so, of course, it's a small number to extrapolate for the full 500, but my sense we will get a better than expected beat simply because the economic data during the third quarter was so very, very strong. You may know the Atlanta Federal Reserve is indicating over 5% GDP growth in the third quarter. And if you exclude energy, by the way, the S&P earnings will be up about 5% year on year. That'll be the first positive reading in 3 quarters. So I think the earnings are what's going to be most helpful, and I think we will have a good rally in the fourth quarter of this year. By the way, I think China can also rally quite strongly because of the stimulus that they've been putting in place. They're setting up a national team to buy stocks in the mainland Chinese market. Xi Jinping and Joe Biden are meeting in San Francisco at the APEC summit next month. So I think there are many reasons why we shouldn't get bearish and why, in fact, markets will move higher over the next few months.
Hi, Mark. Good morning. So last time around as well, you had mentioned that you're expecting quarter 4 to be good for global equities on the whole. My question to you is, what about India? India has outperformed. Will India continue to outperform? Because now the flows have been tapering out a little bit. There are concerns because we're getting into a big election year as well. So how do you expect the Indian markets to perform?
Well, I'll just say from the get-go that it's our favorite market in Asia, and that means, of course, that I like India. We have invested our clients' money and on behalf of our clients on a discretionary basis in India. But on a quarterly basis, of course, there will be times it doesn't outperform. My guess is that this coming fourth quarter, the fourth quarter we're in now, could be one of those, simply because China has done so badly so far this year. But I mentioned earlier, there are 3 reasons why you could get a good rally in China, which, by the way, is what happened in the fourth quarter last year, too. China was up about 15% in the fourth quarter alone last year. And so that Biden-Xi Jinping meeting, the government buying share prices to support the market, and incrementally more stimulus. They announced $1 trillion renminbi, of infrastructure spend last week. I think that, and then you look at India, where it has done well, as you point out, and we are getting some frothy prices in the mid and small caps. It might not outperform in the fourth quarter. I don't know, but I still like the Indian market.
All right, that's a great way to end, isn't it? You still like the Indian market. Mark, always a pleasure speaking to you. Thanks for your quick thoughts on how to approach India as well as the rest of the globe, given the kind of geopolitical tensions that we're dealing with.